$3,100. Let that number sink in. Look at it on your screen. We are not just looking at a new all-time high, we are witnessing the funeral of the old financial order. If you are still pricing the world in US dollars, you are looking at a mirage. The market has just delivered a verdict, and it is a vote of no confidence in the fiat currency system. Welcome to this special market report. I am your host, and today we are breaking down the historic, unprecedented move in the precious metals market that has left analysts speechless and the bears bankrupt. This morning, the price of gold didn't just break resistance, it vaporized it. The $3,100 per ounce barrier, a level that many economists said we wouldn't see until 2030, has been shattered. But this isn't about inflation data. It isn't about a Fed speech. This is about something far more structural, far more dangerous, and far more permanent. Why is this happening now? To understand the price, you have to ignore the noise from the Western media and look east. The engine driving this vertical ascent is not the retail investor on Main Street. It is the central banks of the BRICS Plus alliance. We have just received confirmation of the smoking gun. Data released this morning confirms that the central banks of the expanded BRICS bloc, led by China, Russia, India, and their new partners, have executed their 18th consecutive month of net gold accumulation, 18 months of relentless price-agnostic buying. This is not a diversification strategy. This is a de-dollarization strategy. This is a coordinated geopolitical maneuver. These nations are systematically swapping their U.S. Treasury bonds, their promise of future payment in dollars, for the only asset that has no counterparty risk. They are exiting the dollar system and building a fortress of hard assets. When the biggest whales in the ocean are buying without caring about the price only has one way to go: up. They have created a floor beneath the market that is made of reinforced concrete. They are draining the physical vaults of London and New York, creating a supply squeeze that the paper markets on the COMEX can no longer mask. However, and this is the part you need to listen to very carefully, trees do not grow to the sky, and parabolic charts always resolve in tears for the latecomers. While the fundamental story is bullish for the next decade, the technical reality for the next 10 days is flashing a code red. I want you to pull up the Relative Strength Index, the RSI, on the weekly chart. It is screaming. We are currently sitting at an RSI level that indicates extreme overbought conditions. We are in the statistical stratosphere. The rubber band of valuation has been stretched so tight that it is vibrating. In the history of financial markets, whenever an asset class goes vertical like this, detached from its moving averages by such a wide margin, a violent snapback is inevitable. We are witnessing a blow-off top in the short term. This is euphoria. This is hysteria. This is the moment when your cab driver and your dentist start asking you how to buy gold coins. This divergence between the long-term bullish fundamentals and the short-term technical exhaustion is the most dangerous setup a trader can face. The market is luring you in. It is triggering your fear of missing out, FOMO. It is whispering that if you don't buy now at 3,100, you will have to buy at 3,500. Do not listen to the voice. That voice is the siren song that leads to the shipwreck. Let's analyze the flow of funds. Who is buying at 3,100? The smart money, the institutional players, the contrarians who bought at $2,000 and 2,400 are currently looking at the exit door. They are not buying here, they are feeding the ducks. They are selling into this strength to lock in generational profits. The dumb money, the reactionary retail crowd, is chasing the green candles. They are buying because the price is up, which is the single worst reason to buy an asset. They are providing the liquidity for the whales to exit. If you buy here, you are effectively paying a premium for certainty in an uncertain world, but you are also accepting a massive downside risk. If gold corrects just 10%, which is a standard healthy pullback in a bull market, we are talking about a drop back to the $2,800 level. Can your portfolio withstand a $300 drop per ounce? Can your psychology handle seeing your position immediately go underwater? How will the correction happen? It likely won't be a slow drift. When a parabolic move breaks, it usually happens in a flash crash scenario. All it takes is one piece of news, a ceasefire rumor, a hawkish Fed comment, or simply a lack of new buyers, and the air pocket underneath the price will be exposed. The leveraged traders, the ones who are long on margin futures, will be the fuel for the fire. As the price ticks down, their stop losses will hit. Then the margin calls will trigger automatic selling. This creates a cascade effect, flushing out the weak hands who bought the top. This is the market's way of transferring wealth from the impatient to the patient. Furthermore, consider the currency aspect. The US dollar index, DXY, is currently oversold. If the dollar stages a relief rally, a dead cat bounce, gold will face immediate headwinds. The inverse correlation between the dollar and gold is not dead, it is just dormant. If the dollar wakes up, gold will take a nap. So, what is the actionable advice? What should you be doing with your money right now? Scenario A, you are a long-term holder. If you have been holding gold since the 2000s or lower, congratulations. You have been vindicated. You are sitting on massive unrealized gains. But remember, unrealized gains are just vanity numbers on a screen until you click sell. This is the moment to exercise discipline. I am not saying sell everything. I am saying rebalance. Take some chips off the table. Sell 10 to 20% of your position. Recoup your initial investment capital. Move that profit into cash or undervalued assets that haven't pumped yet. This is called feeding the beast. By locking in profit, you eliminate the emotional stress. If gold goes to $4,000, you still have a position. If it drops to $3,500, you have cash to buy back in. This is how the professionals operate. They sell into hysteria. Scenario B, you are holding cash, the FOMO buyer. If you are sitting on cash and looking at gold with envy, stop. Do not touch the buy button. I repeat, do not chase this trade. Entering a position at an all-time high with an RSI over 80 is financial suicide. You are buying the exact moment of maximum risk. The easy money has already been made. You are trying to pick up pennies in front of a steamroller. Your strategy right now is radical patience. You need to become a sniper. You wait. You let the market cool off. You let the RSI reset. You wait for the inevitable pullback. Mark your charts. Look for the previous resistance turn support. Look at the 2,150 zone. Look at the 2,900 zone. These are your kill zones. If gold retraces to these levels and stabilizes, that is your entry. That is where the risk-to-reward ratio shifts back in your favor. But buying at 30,100, that is gambling, not investing. Zooming out, we must acknowledge what this price action signifies for the global economy. Gold at $3,100 is a fire alarm. It is signaling that the market believes the debt spiral of Western nations is unfixable. It is signaling that higher for longer interest rates are breaking the banking system. The BRICS plus nations know this. They are preparing for a post-dollar world. They are essentially telling us that they no longer trust the U.S. Treasury to preserve their purchasing power. When the global South stops recycling their trade surpluses into U.S. debt and starts recycling it into gold, the game changes forever. We are moving from a system based on trust, fiat, to a system based on truth, gold. Gold cannot be printed. It cannot be debased by a politician. It cannot be sanctioned. It is the only neutral reserve asset in the world. But even in a monetary revolution, prices do not move in a straight line. Volatility is the price of admission. The volatility we are about to see will shake many people out. To summarize, the event. Gold has breached $30,100, driven by sovereign buying from the BRICS Plus bloc. The signal, the long-term trend is undeniable, but the short-term indicators are flashing, overheated. The action, holders, take partial profits. Buyers, stand down and wait for the dip. The market is testing your emotional discipline. It is easy to be a genius in a bull market. The real test is knowing when to sit on your hands. The gold train has left the station, and if you try to jump on it while it's moving at this speed, you will get hurt. Wait for the next stop. Gold has proven it is the king of assets, but even kings need to rest. Stay liquid, stay disciplined, and do not let FOMO dictate your financial future.